Revolving light. What if a listed company's biggest governance failure is not in the boardroom, but inside the audit committee? What if a fraud remains undetected because the audit committee failed to ask the right questions? What if financial statements approved by the board later become the subject of regulatory scrutiny, investor litigation, forensic audits, or SEBI investigations because the audit committee did not perform its responsibilities effectively? Can independent directors be questioned? Can the company face governance consequences? Can investor confidence collapse? The answer lies in Regulation 18 of the SEBI Listing Obligations and Disclosure Requirements Regulations 2015, one of the most important corporate governance provisions applicable to listed entities. If Regulation 17 governs the board, Regulation 18 governs the watchdog of the board itself, the Audit Committee. Welcome to Corporate and Securities Law Compass, Navigating Law with Clarity. Today we are undertaking a comprehensive masterclass on Regulation 18 of the SEBI LODR Regulations 2015, dealing with the Audit Committee. Among all board committees prescribed under corporate governance regulations, the Audit Committee occupies a special position. The board oversees the company. The Audit Committee oversees financial reporting, internal controls, risk indicators, audit processes, compliance oversight, related party transactions, and governance integrity. In many respects, it acts as the first line of defense against financial misreporting and governance failures. The legislative intent behind Regulation 18 is straightforward. Investors invest money based upon trust. They rely upon financial statements, they rely upon disclosures, they rely upon internal control systems, they rely upon governance mechanisms. The Audit Committee exists to strengthen that trust. SEBI therefore requires listed entities to constitute a properly functioning Audit Committee. The historical background behind this regulation is important. Globally, major corporate collapses frequently revealed weaknesses in audit oversight. Financial irregularities often remained undetected because oversight mechanisms failed. Regulators across jurisdictions responded by strengthening audit committee requirements. India adopted similar governance principles through the Companies Act 2013 and SEBI LODR. Regulation 18 therefore represents an important investor protection provision. The first important concept under Regulation 18 is constitution of the Audit Committee. Every listed entity required to comply with corporate governance provisions must constitute an audit committee. This is not merely a procedural requirement, it is a substantive governance mechanism. The committee must possess appropriate composition and independence. The majority of members should be independent directors. This requirement reflects a fundamental governance principle. Financial oversight should be performed by persons capable of exercising objective judgment. Independence reduces conflicts of interest. Independence strengthens accountability. Independence protects minority shareholders. Another important requirement relates to financial literacy. Members of the Audit Committee should possess the ability to understand financial statements. At least one member should have accounting or related financial management expertise. This is a highly practical requirement. A committee responsible for reviewing financial information should be capable of understanding that information. Governance without competence is ineffective. Competence and independence must coexist. The chairperson of the Audit Committee should be an independent director. This requirement reinforces investor confidence. Independent leadership enhances credibility. Stakeholders often evaluate governance quality by examining the effectiveness of committee leadership. Another significant requirement relates to meetings. The Audit Committee should meet periodically. Oversight cannot occur through annual reviews alone. Financial reporting, internal controls, risk management, audit findings, and compliance matters require continuous attention. The frequency of meetings should reflect the importance of the committee's responsibilities. A common examination question concerns quorum. The quorum requirements are specifically prescribed. Professionals should remember that proper constitution and proper functioning are equally important. A committee may be perfectly constituted yet ineffective in operation. SEBI expects both. One of the most important responsibilities of the Audit Committee involves review of financial statements. Before financial results reach the board, they are typically reviewed by the Audit Committee. This review process is not intended to duplicate the statutory audit. Instead, the committee evaluates the quality of reporting, significant accounting judgments, disclosures, and governance implications. The Audit Committee acts as a bridge between management, auditors, and the board. Another major responsibility involves oversight of auditors. The committee reviews auditor independence. The committee examines audit findings. The committee discusses observations raised by statutory auditors and internal auditors. This interaction is crucial. Auditors provide assurance. The Audit Committee evaluates that assurance. Related party transactions represent another critical area. Regulation 23 often receives significant attention. However, Audit Committee approval plays a central role in the related party transaction framework. The committee evaluates whether transactions are in the ordinary course of business, whether they are conducted on an arm's length basis, whether they serve legitimate business objectives, whether shareholder interests are protected. This responsibility is fundamental to corporate governance. Another important responsibility relates to internal financial controls. The Audit Committee should review the adequacy and effectiveness of control systems. Strong controls reduce the likelihood of fraud. Strong controls improve reporting quality. Strong controls enhance stakeholder confidence. A practical example illustrates the significance of Regulation 18. Imagine a listed company reporting consistent profits. An internal audit later reveals significant weaknesses in inventory controls. The Audit Committee reviews the findings, seeks corrective action, and monitors implementation. This demonstrates how governance mechanisms can identify problems before they become crisis. Consider another example. A company proposes a significant related party transaction. Management believes the transaction is commercially beneficial. The Audit Committee evaluates the proposal independently. Questions are raised, additional disclosures are requested, terms are revised. The process strengthens governance. This is precisely why the committee exists. Another important governance lesson emerges here. An effective audit committee does not merely approve proposals. It asks questions. It challenges assumptions. It seeks explanations. It demands evidence. Good governance often begins with the willingness to ask difficult questions. For company secretaries, Regulation 18 is among the most important compliance provisions. Committee composition should be monitored continuously. Meeting schedules should be managed effectively. Agenda papers should be comprehensive. Minutes should capture meaningful deliberations. Approvals should be documented properly. Stock exchange disclosures should be made within prescribed timelines. The company secretary acts as a critical governance facilitator. For directors, membership of the Audit Committee carries significant responsibilities. Attendance alone is not sufficient. Directors must engage actively. They must understand financial information. They must evaluate risks. They must exercise independent judgment. Governance effectiveness depends upon participation. For chartered accountants, the regulation is particularly significant because it directly interacts with financial reporting, audits, accounting standards, internal controls, and disclosure practices. For cost accountants, operational controls, inventory systems, costing processes, and efficiency reviews frequently intersect with audit committee oversight. For advocates, Regulation 18 becomes relevant in governance investigations, shareholder disputes, SEBI proceedings, and litigation concerning financial disclosures or oversight failures. One hidden examination concept is the relationship between Regulation 18 and Section 177 of the Companies Act 2013. Section 177 establishes the Audit Committee framework under company law. Regulation 18 supplements and strengthens those requirements for listed entities. Both frameworks operate simultaneously. Listed companies must comply with both. Students frequently study them separately. Professionals must understand their interaction. Another practical governance insight is that many major corporate scandals involve failures of oversight rather than failures of regulation. Rules may exist, policies may exist, committees may exist. The real question is whether those mechanisms function effectively. An ineffective audit committee can create substantial governance risk. A highly effective audit committee can prevent significant problems. The regulation also has direct implications for investors. Investors often review committee composition, independence, attendance records, and governance disclosures before making investment decisions. Strong audit committees enhance market confidence. Weak oversight raises concerns. From a secretarial audit perspective, several areas require careful review: committee constitution, independence requirements, financial expertise, meeting frequency, quorum compliance, approval processes, related party transaction oversight, documentation standards, disclosure requirements. Any weakness in these areas may indicate governance concerns. Another practical compliance tip involves maintaining detailed records: agenda notes, presentations, audit reports, management responses, committee recommendations, minutes, follow-up actions. These records demonstrate effective governance and become valuable during inspections, audits, investigations, and due diligence exercises. The regulation also connects with various provisions under the Companies Act, SEBI PIT regulations, SEBI LODR disclosure requirements, internal audit frameworks, risk management systems, statutory audit processes, secretarial audit mechanisms, and corporate governance standards. It serves as the central oversight mechanism for financial governance. As we approach the conclusion, it becomes clear that Regulation 18 is far more than a committee constitution provision. It represents the cornerstone of financial governance within a listed company. The audit committee stands between management and stakeholders. It evaluates financial information, scrutinizes risks, oversees auditors, reviews controls, and protects investor interests. When the audit committee functions effectively, governance strengthens. When it fails, risks multiply. In conclusion, Regulation 18 of the SEBI LODR Regulations 2015 represents one of the most significant investor protection and governance provisions in the Indian securities market. It establishes a robust framework for financial oversight, audit supervision, internal control evaluation, related party transaction review, and governance accountability. For company secretaries, chartered accountants, cost accountants, advocates, directors, investors, compliance officers, and governance professionals, understanding Regulation 18 is essential because strong financial governance begins not with the board as a whole, but with an effective, independent, and vigilant audit committee. Disclaimer: viewing this video or accessing the content on this channel are free and does not create any professional, advisory, or client relationship between the speaker and the viewer. The content is shared solely for general educational and informational purposes. The speaker is a member of the Institute of Company Secretaries of India, ICSI. However, the information provided in this video should not be construed as professional advice, consultancy, or opinion under any law or regulation. Viewers should not rely solely on the information provided in this video for making legal, financial, regulatory, or compliance decisions. Any person intending to rely upon or act on the information contained herein should independently verify the relevant provisions of law and, where appropriate, seek professional advice from a qualified professional. The speaker, the Institute of Company Secretaries of India, ICSI, and any organization or listed company with which the speaker may be associated shall not be liable for any direct or indirect loss, damage, or consequences arising from reliance on the information provided in this video or channel. The content shared on this channel is based solely on publicly available information, general legal provisions, and academic discussion of corporate and regulatory frameworks. The speaker confirms that no unpublished price-sensitive information, UPSI, confidential information, or proprietary information of any listed company or organization has been disclosed or discussed in any video or content on this channel. The views expressed in the videos are personal academic interpretations for educational purposes only and are not connected with or derived from any confidential information obtained through employment, professional engagement, or association with any listed company or organization. Nothing contained in this channel should be interpreted as market advice, investment advice, or insider information under the applicable provisions of securities laws, including the SEBI Prohibition of Insider Trading Regulations 2015. Viewers are advised that the information shared is purely for general educational awareness and should not be relied upon for investment decisions, trading decisions, or regulatory compliance without consulting appropriate professionals and official sources.